Nearly a year ago to the day, I posted a video saying that someone needed to be fired over at Fastly. The stock was over $44 per share. Well, guess what? The CEO recently was fired from his CEO position, and not only that, was relieved of his board of director seat as well. We have a new CEO at Fastly, and the stock is down over 71% over the last year. We didn't like it when it was 71% higher. Do we like Fastly today? We'll talk about that and more on today's show. What is going on, investors? Hopefully you guys are doing well out there. Time to talk about Fastly, ticker symbol FSLY. I have not been shy. This stock has been absolute hot garbage, but now it's pulled down into a valuation of just $1.49 billion for the entire company. Gotta believe, even in the regulatory environment that we are in, there's got to be some kind of put option underneath this stock. Now, that doesn't mean it's a great buying opportunity, but we do look at a company that just reported their Q2 earnings after the bell today. We had a revenue coming in at $102 million. That was 20% year-over-year growth, and it did beat expectations by a little bit. Now, we also got a revenue outlook for the Q3 quarter, expected to come in between $102 and $105 million. Consensus was closer to the low end, in fact, underneath the low end at $101 million. We also got full year 2022 outlook, expecting $415 to $425 million worth of revenue. The street had pretty low expectations. They were well underneath the low end there at $411 million. We're showing you for the next couple of quarters over at Fastly, Wall Street wasn't really anticipating a lot of growth. In fact, kind of a mid-teens to even 10% grower over the next couple of quarters. It could be in the coming days. We actually see revisions upwards on this, given the fact that the strong guidance for Q3 and also the full year coming over and above where Fastly's estimates were. Now, when we look out into the future with Fastly, essentially a mid-teens grower, I'm seeing that across the board. We talked about how they have a new CEO, Todd Nightingale, is coming over from Cisco, where he managed a multi-billion-dollar network portfolio over at that company. Now, also, what's coming down over at Fastly when your stock is down 71% and your revenues continue to grow? Well, guess what? Your price to sales multiple starts to look pretty good. Just 3.8 times sales, probably even lower than that when you factor in the forward guidance is coming over and above where the street expectations were. Again, you have to expect this company probably will get bought out at some point, because as you recall, if you've been following our channel, we did not like this stock when it was way up here at $40, $50, even $30 per share, even $20 per share. We did not like this one because you have massive amount of stock-based compensation over here, but that does make it an acquisition target because you can absorb that if you're some kind of mega cap company like a Google or a Microsoft, and it also comes at a much cheaper price this year compared to last year. Now, in terms of those revenues, we went from $85 million last year on a quarterly basis up to close to 103, 102.5 to be exact. We did see gross profit slip a little bit. While it is up year over year, our margins contracted a little bit. Competitive environment over at Fastly certainly weighing on the shares, as well as the stock not really moving in the after hours, although it was up over 7% before the announcement. So off of that $102.5 million worth of revenue in the quarter, we had $46 million worth of gross profit. Now, unfortunately, that was our sales and marketing budget for the quarter, as well, as that came in over our gross profit at $46.8 million. You also had research and development coming in at $38 million. Both of those expenses respectively coming in $8 to $10 million over the previous period. What went down is actually general and administrative. This is often the easiest budget to cut. You went from 35.5 down to 29.5, showing a little bit of discipline over at Fastly, something that we're not used to. Total operating expenses coming in at 115. So yeah, you take this 46 and you minus off $115 million worth of operating expenses, and you got a loss from operations ballooning to $68.9 million. Last year, you're at 57.5. So it is not turned around over at Fastly from an operating perspective. And when we factor in the upcoming quarters likely to be be in that 102, 105, maybe even as high as 110 on a good day. Well, they still have operating expenses that would exceed that if they maintain the run rate, which I would imagine they will over at Fastly. You obviously have negative net income when you examine it all the way down to the earnings. Now, from a balance sheet perspective, some of the companies that we're looking at, they have really bad operations, certainly from a stock-based compensation. I'll show you that from cash flow perspective here in a moment. But Fastly's balance sheet actually not that great. We're looking at some companies that have good balance sheets, maybe make up for that. Over at Fastly, we have a reduction in cash since the beginning of the year. I'll show you what they use that for here in a moment. But you had a reduction of total assets as well from 2.1 down to about 1.9. On the liability side, looks like they canceled out a lot of long-term debt. You went from 933 down to 703. Well, that exceeds the company's total current assets at about 580. So just our long-term debt covering our total current assets. Again, not necessarily that big of a negative thing, especially if you expect this company continue to grow, but not necessarily healthy from a balance sheet perspective. Now we get to pull down a net loss number in the most recent quarter at $16.4 million. Last year, it had ballooned to $58.3 million. We get to add things back in like massive stock-based compensation over the last 3 months came in at nearly $35 million. It was lower last year, but factor in the stock is down over 70%. So despite the really poor performance on the stock, they've actually diluted you more because obviously as the stock goes down, a similar number means exponentially more shares. But for the sake of cash flows, you get to add that back in and you get to net cash provided by the operating activities coming in close to $16.7 million. That's a small improvement over last year where you lost $17 million. Now, they did have positive cash flows down here from the investing activities, essentially canceling out the loss you had here on the operating side. Here's our extinguishing of debt. Here's where the vast majority of cash went in the most recent period. Fastly deciding to retire debt. We probably will see this with more corporates as long as interest rates continue to tick up, because in the past, Fastly would have likely refinanced this $177 million worth of debt. They simply would have rolled it over into another term, but obviously with interest rates ticking up and a company without positive cash flow, positive net income, and a balance sheet that doesn't really cover all of its liabilities, well, banks are probably charging Fastly an arm and a leg compared to what you see the mega cap corporates borrow at. That's going to help Fastly reduce some expenses month over month on that interest side, and it does clean the balance sheet up to a small degree, but obviously not really doing much from a shareholder perspective because obviously this one's on the dumps, and quite frankly, it's very close to the 52-week low of about $9.50 per share. Now, we've been seeing this with a lot of stocks that we've been looking at, especially the speculative stocks. So a lot of the speculative stocks like a Fastly, like SoFi, and many other stocks that we're watching, they were locked in this downward channel like pretty much every stock that I own. But more recently, this is kind of flagged out sideways. So in some ways, we are taking off that downward trend because now I believe the dominant trend with these speculative stocks is actually starting to go sideways. A lot of bad news starting to get priced in. You are making some very mild higher lows here as well. Some would argue as well, you're making some higher highs, certainly bullish in the shorter term over at Fastly. You should have some overhead resistance over at Fastly right here in the $20 region. I'd probably lower it to maybe about $15 to $20. You're going to have to push through a ton of price action in order to get up and above $20. But look, $20 per share is basically $7 higher. That's more than a 50% move on this one. Look, I would not buy Fastly in my retirement portfolio. This certainly wouldn't be a buy and hold stock, but from a short-term trading perspective where you're trading some knowledge of these financials, also noting that the fundamentals might get a little better with a new CEO, and the fact from a cash flow perspective over at this company, while the losses look rather daunting, from an actual cash perspective, it's not as much considering they have pretty high stock-based compensation when it comes to their expenses. I think you can, these are tradable bounces. If this one retraces back towards the $11 per share range, you can get it in that area with the understanding that you put a stop loss underneath the low, probably right here at about $9 $9.50. That would probably be the rock bottom where I'd want to get out of this one, because if you break through the bottom of these channels, we've seen this a number of times with Netflix and certainly Meta or Facebook, probably an example is that you break through the bottom level of support, you don't know where this one go. It's certainly going into penny stock territory, but you get any rumor of some kind of acquisition in this one, or just the momentum stay in this market, well, stocks like these could run a little bit more, because the valuation of just $1.5 billion on top of acceptable mid-teens growth into the foreseeable future, certainly not, again, not a stock I'm going to build my entire portfolio around, but one you could certainly make some money on. If you like this one at a higher price and all of a sudden you've turned sour on it, you need to change your perspective as an investor. You should get much more excited when the valuations are low, and when the valuations are high, you probably should steer clear. Hopefully, guys, enjoyed today's video. We'll be back again soon with more. Good luck with your investments.